Most people pick their retirement month based on when they feel ready, when the bonus hits, when the vacation days reset, when the project wraps up. What almost nobody considers is that the month you walk out the door determines your tax bill, not just for that year, but for the next 3 years after it. The IRS does not calculate your taxes based on the day you retire. It calculates them based on the calendar year. And the difference between retiring in January versus July versus December can be $5,000, $10,000, even $20,000 in total taxes over the following 36 months. I'm going to walk you through 5 specific ways the month you retire changes your taxes, your Medicare premiums, your Roth conversion space, your health insurance costs, and your capital gains rate. Each one operates on a different calendar. Each one has a different look-back window. And if you do not coordinate them, you will overpay on at least 3 of the 5 without ever knowing it. Before I get into it, I need to be clear. I'm not a lawyer. I'm not a CPA. I'm not a financial advisor. Nothing in this video is legal, tax, or investment advice. These are educational examples based on current tax law and publicly available IRS information. Always consult a qualified tax professional for your specific situation. My name is Ivy, and if you are new here, this channel is for one specific group: retirees and pre-retirees over 60 who want to understand how the IRS actually works in retirement. Not the version your HR department handed you at the exit interview. The real version with real numbers in plain English. If that sounds like you, subscribe right now because the video I'm putting out next week is going to show you the 5 financial positions you need to restructure before your last paycheck. And that one is worth watching before you give notice. Drop a comment right now. What month are you planning to retire, or what month did you retire? Just the month. January, March, July, whatever it is. I read every single comment, and the most common months are going to determine which examples I use in the follow-up video. 2 seconds. Do it now. Let us get into it. Number 1, the month you retire determines how much federal income tax you pay that year. This sounds obvious, but the math surprises almost everyone. The IRS taxes you on your total calendar year income, January 1st through December 31st. If you retire on January 31st, you have 1 month of salary income for the year. If you retire on September 30th, you have 9 months of salary income. That difference is not just about how much you earned. It is about which tax bracket you land in. In 2026, the 12% bracket for a married couple filing jointly goes up to $100,800 of taxable income. The 22% bracket starts immediately after that. If you earn $120,000 per year and retire on July 1st, your salary for the year is about $60,000 after the standard deduction of $36,300 for a couple both over 65. Your taxable income is roughly $23,700. You are deep in the 12% bracket. Federal tax about $2,844. Now imagine the same person retires on November 30th. 10 months of salary, $100,000 in gross income. After the standard deduction, taxable income is $63,700. Still in the 12% bracket, but your federal tax is about $7,644. The difference between retiring in July and November on the same salary is roughly $4,800 in federal income tax. Same job, same pay rate, different month, $4,800. But the real cost is not the tax on the salary. It is what the salary does to everything else. Number 2, the month you retire determines your Roth conversion space for that year. This is the one that costs people the most money over a lifetime, and it is entirely controlled by which month you stop working. Roth conversions are taxed as ordinary income. They stack on top of whatever other income you have. If you retire in January, you have 11 months with 0 salary income. That is 11 months of empty bracket space that you can fill with Roth conversions at the 12% rate instead of 22% or higher. If you retire in October, you have only 2 months of empty bracket space. The salary already filled most of the 12% bracket. The conversion room that is left is a fraction of what it would have been with an earlier exit. Let me put real numbers on this. A married couple earning $120,000 per year. Standard deduction $36,300. The 12% bracket goes up to $100,800 in taxable income. If they retire January 31st, their salary for the year is $10,000. Taxable income after deduction 0. Available conversion space in the 12% bracket, $100,800. If they convert that full amount, the federal tax on the conversion is about $12,096. But that money is now permanently in a Roth, growing tax-free with no RMDs and invisible to the Social Security taxation formula in IRMA for the rest of their lives. If the same couple retires October 31st, their salary is $100,000. Taxable income after deduction, $63,700. Available conversion space in the 12% bracket, $37,100. They can convert less than 40% of what the January retiree could convert. The gap between those two scenarios is $63,700 of Roth conversion space lost forever because of 9 months of extra work. At a 12% rate, that lost conversion would have cost them $7,644 in taxes. Now, instead, those dollars stay in the traditional IRA, grow, and eventually come out as RMDs at 22% or higher. The lifetime tax cost of that timing difference can easily exceed $20,000 on a single year's decision. Did you know the month you retire controls your Roth conversion space? Drop yes or no in the comments. I'm genuinely curious because this is the single most overlooked timing decision in retirement tax planning. Number 3. The month you retire determines your Medicare premiums for 2 to 3 years. This is the one that catches people completely off guard because Medicare does not use your current income to set your premiums. It uses your income from 2 years ago. IRMA, the income-related monthly adjustment amount, is a surcharge on your Medicare Part B and Part D premiums that kicks in when your modified adjusted gross income exceeds $19,000 for single filers or $218,000 for married couples filing jointly. The 2-year look back means your 2026 income determines your 2028 premiums. Your 2027 income determines your 2029 premiums. Now think about what this means for retirement timing. If you retire in January of 2026, your 2026 income is minimal. 1 month of salary plus whatever you choose to withdraw or convert. Your 2028 Medicare premiums will be based on that low-income year. Standard premium, no surge charges. If you retire in November of 2026, your 2026 income includes 10 months of salary. If that salary pushes your Maggie above $109,000 as a single filer or $218,000 as a couple, you are paying her surcharges in 2028. The first ARMA tier adds approximately $81.20 per month to your Part B premium. That is $974 per year per person. For a married couple, both on Medicare, that is $1,948 per year. That is just the first tier. Higher income pushes you into higher tiers, where the surge charges are dramatically larger. At the highest tier, Part B alone can cost $689.90 per month, more than triple the standard premium. Now, here is the critical detail. You can appeal your IRMA determination if you have had a life-changing event and retirement qualifies. You file Form SSA-44 with the Social Security Administration and ask them to use your current lower income instead of the 2-year-old higher income. This works, but it requires documentation. It requires filing the form correctly. And most importantly, it requires knowing that the appeal exists. The IRS does not tell you. Medicare does not tell you. Your employer definitely does not tell you on your last day. If you plan your retirement month so that the high-income year falls as far back as possible in the 2-year look back, you minimize the number of months you pay RMA surge charges before the appeal takes effect, or the look back catches up to your lower retirement income. The optimal strategy for many people is to retire as early in the calendar year as possible, so the calendar year income is low, and the IRMA 2-year look back hits a low-income year as soon as possible. January and February retirements produce the cleanest IRMA outcome. November and December retirements produce the worst. Let me show you the actual IRMA tiers so you can see what crossing a line costs. In 2026, for a single filer, the first tier starts at $109,000. The surge charge adds $81.20 cents per month to Part B, which is $974 per year. The second tier starts at $137,000. The surge charge adds $24 per month or $2,248 per year. The third tier starts at $170,000, adding $326.80 per month. The fourth tier starts at $25,000, and the top tier at $500,000 adds $480 per month, bringing Part B alone to $68.990 per month per person. For married couples, multiply each surcharge by 2 if both spouses are on Medicare. A couple in the second RMA tier is paying nearly $5,000 per year in extra Medicare premiums. That is not healthcare. That is a second tax bill triggered by income from 2 years ago. Now here is the Form SSA-44 strategy that most people miss entirely. When you retire, that qualifies as a life-changing event under SSA rules. You can file Form SSA 44 and ask the Social Security Administration to use your current year income or an estimate of it instead of the 2-year-old income that triggered the search charge. You need 3 things: the form itself, which you can download from SSA Gov, proof of the life-changing event, which is typically a letter from your employer confirming your retirement date, and an estimate of your current year income. You submit it to your local Social Security office by fax or mail. Processing takes 4 to 8 weeks. If approved, your IRMA search charge drops or disappears entirely for that year. The mistake most people make is not filing the form at all. They see the IRMA notice, assume it is permanent, and pay the search charge for an entire year or longer before the look-back naturally catches up to their lower retirement income. Filing SSA-4 immediately after retirement can save you the search charge for the first year, which for a married couple in the second tier is nearly $5,000. That is $5,000 saved by filing one form. Number 4, the month you retire determines your health insurance cost if you are under 65. If you retire before you're eligible for Medicare at 65, you need health insurance from the Affordable Care Act Marketplace or from COBRA, and the cost of Marketplace insurance depends entirely on your income for the full calendar year. ACA premium subsidies are calculated based on your household's modified adjusted gross income. The lower your income, the larger the subsidy. If you retire in January and your income for the year is $40,000 from controlled IRA withdrawals, you may qualify for substantial subsidies that reduce your monthly premium to a few hundred. If you retire in August and you have already earned $65,000 in salary, your full year income is higher and your subsidy is smaller, you could be paying $500 to $800 more per month in premiums for the remaining 4 months of the year than you would have paid if you had retired 4 months earlier. For a couple in their early 60s, Marketplace premiums before subsidies can run $1,000 to $2,200 per month. The subsidy is what makes it affordable, and the subsidy is what the retirement month controls. There is also a COBRA consideration. If your employer offers COBRA, you can continue your employer's health insurance for up to 18 months after leaving. The catch is that you pay the full premium, including the portion your employer was covering. That typically runs $500 to $800 per month for an individual and $1,200 to $2,000 for a family. COBRA is expensive, but it guarantees coverage during the transition to Marketplace or Medicare. The month you retire determines how many months of COBRA you need and how they interact with your full year income for ACA subsidy purposes in the following year. If you have made it this far in the video, you are exactly the kind of person this channel is built for. Hit the like button right now. It takes 1 second and it tells YouTube to show this video to more pre-retirees who need to hear this before they pick their retirement date. And if you're not subscribed, do it now. The video I'm putting out next week on the 5 things to sell before you retire is going to save some of you real money. Number 5. The month you retire determines your capital gains tax rate for the year. In 20 to 26, the 0% long-term capital gains rate applies to married couples with taxable income below $98,900 and single filers below $49,150. Above those thresholds, the rate jumps to 15%. If you retire in February, your salary income for the year is low. Your taxable income after the standard deduction may be well below the 0% threshold. That opens a window to sell appreciated investments in your taxable brokerage account and pay 0 federal tax on the gains. You can immediately reinvest the proceeds, resetting your cost basis to the current higher value. When you eventually sell those investments years later, the gain is calculated from the new higher basis. You erased years of embedded gains without paying a penny. 8. If you retire in October, your salary for the year has already consumed most of the space below the 0% threshold. There is little or no room to harvest gains at 0%. You either pay 15% now or hold the investments and pay 15% later when RMDs and Social Security push your income above the threshold permanently. Let me put numbers on this. A married couple with $40,000 in embedded capital gains retires in March. Their salary for the year is $25,000. After the standard deduction, their taxable income is negative. They have the full $98,900 of 0% space available. They sell the investments, realize the $40,000 gain, pay 0 federal tax, and reset the cost basis. The same couple retires in September. Their salary for the year is $90,000. After the standard deduction, their taxable income is $53,700. Available 0% space, $45,200. They can still harvest most of the gain, but not all of it. And next year, when their income includes Social Security and RMDs, the window may be even smaller. On a $40,000 gain, the difference between 0% and 15% is $6,000. One decision about which month to stop working determined whether that $6,000 stayed in their pocket or went to the IRS. Now, let me connect all five together because this is where the real power of timing shows up. Imagine a married couple, both 64, earning a combined $140,000. They are planning to retire sometime in 2026. They have $350,000 in a traditional 401k, $100,000 in a taxable brokerage account with $50,000 in embedded gains, and they will turn 65 and enroll in Medicare in 2027. Scenario A, they retire on December 31st, 2026. Full year of salary, $140,000. Federal tax approximately $13,000. Roth conversion space at 12%. Zero the salary filled the brackets. Capital gains harvesting at 0%, zero income too high. 2028 IRMA based on 2026 income of $140,000, which is above the $109,000 single threshold, but below the $218,000 joint threshold. So they may avoid IRMA depending on filing status. ACA not needed because they turned 65 in 2027. Scenario B, they retire on March 31st, 2026. 3 months of salary, $35,000 federal tax on salary after deductions approximately zero Roth conversion space at 12%, approximately $65,000. They convert $65,000 at 12%, paying about $7,800 in conversion tax capital gains. Harvesting, they sell $50,000 and we earn in appreciated investments at 0%, saving $7,500 in capital gains. Total tax paid approximately $7,800. 2028 8 IRMA based on 2026 income of $35,000 salary plus $65,000 conversion equals $100,000 below the $109,000 threshold. No Hermes search charges. The difference between Scenario A and Scenario B over 3 years, approximately $12,000 to $15,000 in taxes saved, $65,000 permanently moved into a Roth IRA, $50,000 in capital gains tax-free reset, and zero surcharges in 2028. Same couple, same money, same retirement, 9 months earlier. There is a sixth timing effect that connects to everything I just showed you, and most retirees discover it the hard way. Estimated tax payments. When you stop working, your employer stops withholding taxes from your paycheck. But the IRS still expects you to pay taxes throughout the year. If you retire in March and do nothing about estimated payments, you will owe a large chunk of tax on April 15th of the following year, plus a potential underpayment penalty of 7 to 8% annually on the amount you should have paid quarterly. The IRS expects estimated payments on 4 dates: April 15th, June 15th, September 15th, and January 15th of the following year. If you retire in March and do a $65,000 Roth conversion in June, you need to make an estimated payment by September 15th, covering the tax on that conversion. If you do not, the penalty starts accruing. The fix is straightforward. On the day you retire, set up estimated tax payments through IRS, Gov, SARC payments. Use Form 1040-ES to calculate what you owe each quarter based on your projected income for the year. If you are over 62 and recently retired, the IRS offers a penalty waiver for underpayment. You request it by filing Form 2210 with your return, but the waiver is not automatic. You have to know it exists, and you have to check the box. The estimated payment trap is especially dangerous in the retirement year because your income is a mix of salary from the first part of the year and retirement income from the second part. Your withholding from the salary months may not cover the tax on the conversion and capital gains harvesting you do in the non-salary months. You have to project the full year and pay accordingly. There's also the Social Security interaction for people who are already collecting benefits when they retire from their job. If you are 64 and collecting Social Security while still working, your provisional income is sky high because your salary pushes you deep into the 85% Social Security taxation zone. The month you stop working is the month your provisional income starts dropping. If you retire in February, you have 10 months of lower provisional income and potentially less Social Security taxation for that calendar year. If you retire in November, you have only 1 month of lower provisional income and almost no benefit. For a retiree collecting $24,000 in Social Security and earning $80,000 in salary, the provisional income while working is approximately $80,000 plus $12,000, which is half the Social Security, equaling $92,000, deep in the 85% zone. If they retire in March, salary drops to $20,000. Provisional income for the year is approximately $20,000 plus $12,000 equals $32,000. They are at the edge of the 50% zone instead of the 85% zone. That shift can save $1,000 to $2,000 in federal tax on Social Security for that single year. And here is the part that makes this even more powerful. The couple in scenario B does not actually stop earning money in April. If they want, they can do part-time consulting, freelance work, or a low-stress job that earns $20,000 or $30,000 a year. As long as their total income stays below the ARMA and conversion thresholds, they keep all the tax benefits of the early retirement date. The key is ending the full-time W-2 employment that was filling their brackets. The month that employment ends is the month the tax math changes. There is one more thing I need to tell you about, and it is something that almost nobody discusses in the context of retirement month timing. Your last paycheck often includes acred vacation pay, a final bonus, or deferred compensation. All of that income falls in the calendar year it is paid, not the calendar year you stopped working. If you retire in December and your employer pays out 3 weeks of vacation in January, that payout counts as 2027 income, not 2026. If you retire in January and the vacation payout comes in January, it counts as 2026 income and it compresses into the same calendar year as your remaining salary. The timing of these final payments matters for IRMA, for Roth conversion space, and for capital gains harvesting. Ask your HR department exactly when each final payment will be made and factor that into your calendar year income projection before you commit to a retirement date. Let me give you a concrete example of how this can blindside you. A viewer emailed me last month who retired on December 20th of 2025. She assumed her income for 2025 was locked in, but her employer paid out 4 weeks of acred vacation on January 3rd of 2026. That $20,500 payout plus a deferred bonus of $8,000 that also hit in January added $10,500 to her 2026 income. She had planned to do a large Roth conversion in January at a low bracket. The unexpected income filled part of that bracket and reduced her conversion space by $10,500. It also pushed her provisional income higher, increasing the taxable portion of her Social Security for 2026. If she had asked HR about the payout timing before choosing her retirement date, she could have either negotiated the payout into December, keeping it in the 2025 tax year where her income was already high, or she could have adjusted her conversion plan for 2026 to account for the extra income. 10 minutes of asking questions would have saved her roughly $1,200 in taxes. The rule is simple. Before you commit to a retirement date, get a written confirmation from your employer of exactly when every final payment will be made. Salary, bonus, vacation, deferred compensation, stock vesting, everything. Then map each payment to the correct calendar year and recalculate your tax projection. Do not assume the payments land in the same year as your last day of work. They often do not. Here is what I want you to do right now. 3 things. First, pick your target retirement year. Then, model 2 scenarios, retiring in the first quarter versus the last quarter. Calculate your total income for each scenario and see which bracket you land in. The difference is your Roth conversion space and your capital gains harvesting window. Second, calculate your IRMA exposure. Take your projected income for each scenario and check it against the 2026 IRMA thresholds. 109,000 single, 218,000 joint. If either scenario puts you above the threshold, the 2-year look back means you are paying surcharges in 2028. Moving the retirement date earlier can pull you below that line. Third, if you're under 65, model your ACA subsidy eligibility. The marketplace uses your full year income. An early retirement with controlled withdrawals can qualify you for thousands of dollars in premium subsidies. A late retirement with 10 months of salary can disqualify you entirely. And one more thing, if you do retire and your income drops significantly, file Form SSA 44 with the Social Security Administration to request an IRMA redetermination. Retirement qualifies as a life-changing event. You can ask them to use your current lower income instead of the 2-year-old higher income. This form is free. It takes 15 minutes and it can save you $1,000 to $5,000 per year in Medicare search charges. Do not wait for them to adjust automatically. They will not. You have to file. Drop a comment and tell me which of the 5 timing effects surprised you the most. Just the number 1 through 5. That number tells me exactly what to cover in the next deep dive video. And the most common answer becomes next week's full episode. If this helped you, hit like, subscribe if you have not already. I make videos like this every week. And the next one, the one about the 5 things to sell before you retire, is going to change some of your financial plans. I will see you in the next